housing market just fell for the 7th month in a row according to the new Black Knight monthly report, with home prices seeing a decline of 0.24% in January. Now this may not sound like a lot, but after 7 consecutive months of home prices falling, it means that the housing market is now down 5.5% from the peak in June. There were a number of other concerning things from this Black Knight report in regards to where the housing market is heading in the future, one of which is the current housing unaffordability crisis. Now, housing affordability remains at historic lows and is demonstrated perfectly in the payment to income ratio metric, which as you can see is still up there at the highest levels that we've seen in recent history. Now, the average percentage of median income that is needed to make a monthly mortgage payment on the average price home is now 33.2%, which is up from the previous month but still slightly lower than the highs that we saw a few months ago. Now this means that we are still roughly level with the absolute peak that was seen during the housing market crash during the global financial crisis, and many people are really struggling to afford a home right now, especially those that are not already on the property ladder. Now house prices are only marginally lower than the all-time highs and are still far higher than levels that we saw pre-pandemic. Now if we combine this with the astronomical mortgage rates that are 3 times higher than a couple of years ago, and stagnant wage growth that has not been growing at nearly the same rate as the growth in house prices, we are seeing buyers hold back for now and wait until a later date to buy a home. This is leading to more people living with parents, renting and finding co-living arrangements instead of buying their own property, which is having a hit on the home demand. Now what's even more concerning when it comes to housing affordability and the payment to income ratio is that the average 30-year mortgage rates have actually climbed higher since February and are very likely to continue climbing throughout 2023 and surge past 7% to reach new highs, which obviously hits housing affordability even more. This is because the interest rate or federal funds rate is not expected to peak until later on in 2023, according to FOMC members. However, stubborn sellers are really propping up the housing market right now and are partly responsible for the housing market continuing to trickle down month by month for the time being, rather than dropping like a brick. And sellers are doing all that they can to remain situated in their current home right now, because after all, who would want to move house today and take out a new mortgage in the current interest rate environment? Now many homeowners are currently enjoying mortgage rates that are far below today's levels, especially those who bought in 2021 or before, who are in many cases enjoying mortgage rates 2 to 3 times lower than what they would have had to pay if they took out a new mortgage right now. It would take quite a desperate situation for someone to sell their house right now and to move to another one, especially if it is unforced and the individual is not moving to another part of the country, nor are they in financial difficulty. And it is for this reason that the significant fall in demand for homes is largely being balanced out by the fall in supply, that is keeping inventory levels relatively low across the country and preventing any sharp falls in the housing market for the time being. Now, this chart from Goldman Sachs is extremely eye-opening and shows that 99% of homeowners who currently have a mortgage are locked into an interest rate that is below the current rate. And this further drives home the point that stubborn sellers are propping up the housing market right now, but gradually over time, these sellers will start to be forced into selling or remortgaging. Now, both of which will have a negative impact on the housing market. Unless somebody wants to be in one location for the rest of their life, they are going to eventually want to move homes, which does mean giving up their current low mortgage rate agreement and taking on a mortgage at a higher rate. And this of course often means downsizing to a smaller home in order to afford it, or being forced to rent or move in with family due to not being able to afford the current cost of housing. This also applies to those individuals who have a short-term fixed-rate mortgage or a variable rate mortgage as well, who will be forced into a higher interest rate mortgage at some point in the future. Now, according to Redfin, home prices have fallen annually for the first time in a decade thanks to sky-high mortgage rates, reporting that the median US home sale price declined by 0.6% year over year in February. Now, this is the first annual drop that we have seen since 2012, marked by the typical US home now selling for $350.2k, with likelihood of this average price continuing to go lower being quite high, as mortgage rates are showing no signs of returning to pre-2022 levels anytime soon. Now, median asking prices are noticeably higher proportionally to the 2022 peak compared to the actual sales price, which does signal that many sellers are in denial at what they can actually get for their home in the current housing market conditions. And this is summed up quite nicely on the following graph, showing what the average home price is selling for as a percentage of the list price, which has fallen to 98%. This means that sellers are having to settle for a sale price that is 2% lower than their asking price on average, which is down to levels last seen in early 2020 and much lower than anything that we have seen in the last couple of years, much lower than the bidding frenzy that we saw in summer of 2022, where most homes were selling for much above the asking price. On top of this, we can see that there is still a considerable number of listings having price drops, which now sits at 4.9% of listings. Now this is lower than the heights that we saw during the first panic stage of autumn in 2022, but still far higher than anything that we have seen in early 2022 as well as 2021 or 2020. Now, as mentioned before, stubborn sellers are likely to be containing this for the time being, as sellers that are not distressed are under no rush to sell their home and are not desperate to offload it due to the mortgage rate being so high right now. But either way, it is still very telling that there are a considerable number of homes receiving price drops right now, and does suggest these may be coming from an increased number of distressed sellers looking to offload their home quickly. And this may be because they are under financial pressure as a result of the cost of living. The number of layoffs that are happening right now as well could play a factor, and also how unaffordable housing is right now overall. Now, on the topic of distressed sellers, we are also starting to see the early stages of widespread mortgage delinquencies, with the number of delinquencies increasing in the fourth quarter of 2022, according to Mortgage Bankers Association, one of the most reliable sources out there for this type of stuff. And in this research, it is reported that delinquencies are up 0.51% from Q3 of 2022, and this is attributed to a weaker economy and ongoing inflationary pressures. And mortgage delinquencies does track very closely with unemployment, which to be fair has been quite resilient recently, with the unemployment rate declining to 3.4% in January. And this is despite a large number of reported layoffs across various multinational companies, including all of the big tech companies. So I do have a bit of a hard time believing that this unemployment figure is fully transparent. But despite the strength of the job market with the official numbers, MBA do still forecast that there will be slower hiring and rising unemployment by the end of the year, which they expect to rise to 5.2%, and this will of course lead to an increase in mortgage delinquencies as people will not be able to afford their payments. MBA also did note that despite the recent uptick in delinquencies, the foreclosure starts rate of 0.14% was well below the historical quarterly average of 0.4%, and this is largely because many distressed homeowners have loss mitigation options available to them right now and also have accumulated home equity since they first bought the home. Now the thing is with this is that these loss mitigation options may not always be available for them further in the future, and those that have accumulated home equity may not still be in that position for too much longer if the housing market does continue to trickle downwards. The further that the housing market does fall, the more homeowner equity does get eroded, and many homeowners may find themselves in a position where they are in negative equity, which is where they owe more money to the bank than their house is actually worth as of that moment, which of course is a dangerous position to be in when it comes to foreclosures. And looking at the historic data for the interest rate and the unemployment rate, we can see that there is a very clear correlation in which the unemployment rate does follow the direction of the interest rate, but does lag behind by a few years. Now, using this historical data, we can therefore predict with fairly high confidence that the unemployment rate will increase quite rapidly over the next few years and reach heights that are quite possibly higher than the 5.2% that was predicted by MBA. Now, the interest rate has surged rapidly over the last year or so, as everyone knows, but unemployment has not risen at all and is in fact at historical lows. Now, this does make sense to an extent given the time lag that we normally see on the unemployment rate reacting to interest rates, but this does spell bad news for the next couple of years, in which we are very likely to see the unemployment rate surge just like the interest rate has done, certainly if decades of historical data and correlation is anything to go by. Now, a rising unemployment rate is obviously a bad thing for the housing market, as it does mean that people will lose their jobs, which will lead to an increase in distressed sellers and mortgage delinquencies, ultimately leading to an influx of housing supply onto the market. Another big factor at play here is investor interest, and in fact it seems like investors are withdrawing from the housing market at a rapid rate, which could hit housing demand significantly, which would drive home prices down. I cover this in more detail along with other emerging housing market data in my previous video, which you can click on the screen right now to watch. Aside from that, please leave a like on the video if you enjoyed it, that does help out the channel a lot. Also drop me a comment as well, let me know what your thoughts are on the current state of the housing market and where you think it will be heading in the near future. And be sure to subscribe too if you want to see more videos similar to this in the future. And apart from that, thanks a lot for watching.